So when capital is in fear, it will typically shelter in government bonds. So recession, war, these are examples of when money comes out of the stock market and heads into treasury bonds, typically looking for safety. Now, there are rare occasions historically when both the stock market and the treasury bonds are crashing together. And this is a kind of an environment that we're heading into in the not too distant future. This is a really uncommon opportunity. But again, what happens when the bond market gets turned upside down? It does cause a reversal in capital flight away from treasuries, back into the stock market. So again, you typically see this in a crisis, panic to the downside in the stock market, which is the normal shift. However, eventually, when you get a panic in the bond market, the panic in the stock market is to the upside, and this will cause a great deal of confusion for investors who don't understand this really rare market pattern. And it's something again that you typically would only see perhaps once a century. So in order to prepare for this opportunity, again, just remember in a crisis, you'll typically see the shift of money, capital coming from the stock market into treasuries. In a sovereign debt default cycle, you'll see an initial crash in stocks and then a reversal out of bonds when investors really come to realize the real risk is sovereign debt defaults. So quick shout out to Martin Armstrong, Armstrong Economics, tremendous investor, trader, creator of the legendary Socrates cyclical models. Really credit him for this historical information.